Hi folks, welcome to this special live premium episode of Brokenomics, where Dan and I will be discussing US capitalism melting down in front of our eyes. Which is a bit concerning, but you have been predicting this for a while.
Yeah, this has basically been the whole theme of Brokenomics. That's why I call it Brokenomics. It's explaining that this is coming. Now, yesterday, of course, on the podcast, we did a segment on Silicon Valley Bank. And to be fair, as much as anything, we called it Silicon Valley Bank Explained because it was going to drive clicks because that's the sort of thing that people are searching for at the moment.
That's also what it was.
Well, yeah, but that's too zoomed in for what's really going on. I think that Silicon Valley Bank, what happened to that is a symptom of a much, much bigger problem. And we've basically got ourselves now into sort of the point where it's just a rolling cascade of crises. And it's being manifest this week as Silicon Valley Bank. But it's part of a much bigger thing. I mean, look, let's zoom out to the big view, the really zoomed out, the 40,000 foot.
Well, before we go on, a few other banks also collapsed, didn't they?
Oh yeah, well, Silvergate collapsed a bit before within the week, and then was it Principal or I forget the Signature right, Bank that went a couple of days later. Although there is some shenanigans with that particular bank as to what went on there, and I'm sure that's going to come up in the questions that are being fed in at the moment. But it's manifesting through that. But the big issue that we're having is. I don't want to make this too generational, but I can't not really. It's the boomer generation for the last 40 years have been voting themselves ever larger governments and an ever larger series of entitlements. And we got to the point now where US debt, I mean, I'm talking primarily about the US. I mean, this will spread, it will be contagion, it will be the whole indebted Western world. But I'm going to focus on the US because that's the point of it. And that's the tip of the spear. It's where most of the debt is accumulated. And this is where we're going to sort of see this manifest first. The US has accumulated for itself 30 trillion in debt, which is the same size as its economy. So that in itself is bad when your debt is as much as your income. But actually,
Just as a quick thing, who is this debt owed to again?
Oh, it will be everybody. So they force their own pension funds, their own insurance companies, their own companies, their own banks to buy it. I mean, that's part of what happened to Silicon Valley Bank. They were forced to buy this debt.
Right.
So there's some of it. The Chinese own a bit, although they stopped buying maybe in 2013, something like that, because they realised, oh, hang on, US is never going to be paying this back, are they? So they stopped buying ages ago. And all over the world. So, I mean, UK pension funds will hold some. UK investment managers will hold some. So there's probably some of it in your pension, but it's everybody owns this debt. Now, on top of the 30 trillion debt that they've got, which is bad enough because it's the same size as their economy, there's another 170 trillion in unfunded liabilities.
Right.
So this is basically promises to the boomers to pay them in retirement a certain level of income, pay their medical bills, and a whole bunch of other things that come with it. So you add up the total debt, and you've got 200 trillion in debt. You can't get a 200 trillion block of debt through a 30 trillion hole. It's not going to work.
I mean, the interest on this is going to be staggering, isn't it?
Oh, I mean, the interest is soaring. So, I mean, I know the UK figures. It is now the largest line item, with the exception of the NHS, and it could well overtake that.
Yep.
So we're effectively paying for a whole nother NHS, but we're doing nothing apart from servicing this debt obligation. So, I mean, this issue could be solved by scrapping pensions, scrapping the NHS, scrapping welfare, all of those sort of entitlement provisions. We could scrap all of that, and that was effectively get us out of the situation. But the boomers are the biggest voting bloc, and they're not going to vote for it. And to be fair, the millennials, they're the second biggest voting bloc, and they're not going to vote for it either, because otherwise it means that their parents are going to be moving in with them very soon.
Yeah.
So Gen X might like the idea, but maybe the Zoomers might like it, but it's just not going to happen. There's no political will for any of this to happen at the moment. So the situation that we've basically got is that the US is trying to create, all of the Western world is trying to create value through the printer. Now, when I was, there's no finance school, but you do courses and that kind of stuff, and you're taught that the US is never going to default, the UK will never default, because they can print their own money supply, so it will never run out. And the logic of that is, you look at something like Sri Lanka. Sri Lanka went bust because they did a whole load of stupid shit, such as the WEF policies on farming.
Yep.
So they reduced their agricultural output. But what really was crunch point for them is they ran out of dollars. And their obligations were in dollars. But what I primarily mean by that is they needed to buy diesel.
Yeah.
And diesel is priced in dollars. They couldn't do it. And therefore, the diesel stopped coming in. They couldn't even operate the reduced farming output that they had. I mean, you were back to sort of men walking around with shovels and trowels and scythes at that point. The farming equipment didn't work because they had these external obligations. And the thinking is that the US will never experience that because it can print its own money. Here's the problem. Those obligations that it's got queued up effectively are a foreign currency.
Right.
Because they don't owe dollars. What they owe is medical provision to their seniors.
They owe services.
Yeah, they owe services. Now, you can squeeze this to a point. You can keep squeezing down how much you pay doctors and whatever else, and you can squeeze down the amount of pension. But ultimately, they are expected to provide something, and the voting bloc is there to ensure that they provide an actual something, as opposed to just an amount of money that doesn't actually buy you anything. So this is the problem that the world's been grappling with: is that you've got you need to create something out of nothing. And they've been working on a way to try and get that to come true for at least the last 20 years. And every time that this starts to break, they double down. So we touched on it yesterday in the podcast. We talked about how, in 2000, you could have dealt with it honestly then. You could have had a reckoning. It would have been like a mini Great Depression, but you could have got through it. But instead they thought, okay, well, we're not going to have a dot-com crash. Let's inflate a housing bubble to get us out of this. Right. That then led to the mortgage-backed securities housing crash that you got in 2008. And again, we would have had instead of a mini Great Depression, we would have had a proper Great Depression at that point, but we could have dealt with it honestly. But they thought, no, let's create an everything bubble by just printing loads of money to get out of that. Right. So then we get to 2020.
It's driving me mad hearing it. Because I'm not an expert, but I can see exactly what you're saying here.
Yeah.
And it was there no one in the room just being like, look, this won't solve the problem?
Oh yeah, no, they all know it. But
they're just thinking, what, we're going to die before it's our problem?
No, you want the next guy to be in office when the problem manifests.
Yeah, that's what I mean. So yeah, but I mean, at the end of the day, if wealth is liquidated, then no one can call themselves rich, so they will have ruined their own position anyway. So are they just assuming that they'll have passed on by the time?
Well, you just keep kicking the can down the road, and hopefully you're gone by the time it gets to that point.
Brilliant.
So in 2022, the cheap money blew up because of all this extra inflation. So we got the inflation problem. So they said, okay, well, rather than deal with this honestly, let's create a short-term bubble in bonds. So they try and get themselves out of it by ramping up short-term rates.
Yeah,
and now that's blowing up.
Brilliant.
Now, again, we could have an honest reckoning at this point. But the problem is, at this point, it's kind of gone beyond Great Depression levels. This would be a Venezuelan type collapse. I mean, this would be eating the farm animals the zoo animals at this point.
Yeah.
So the desperation is to find a way to bubble up and try and get out of this one more time.
You know what we need? Another bubble.
Because that's the only way you can get past it. Yeah.
Well, would it not be possible to essentially create a new currency that was, say, backed by gold, that you would be like, right, okay, we're all going to use, denarii or something?
Yeah,
that actually was a solid currency?
You could go back to gold. You could use Bitcoin, but they don't want to do that. The only thing they might consider is a central bank digital currency.
Brilliant.
But that isn't ready yet.
Right.
So the can has got to be kicked down the road at least that far.
Okay.
And to be fair, gold, it's not really suitable for a modern economy.
Sure. Yeah.
I mean,
I was just
you would have to sort of digitize it in some way.
Yeah.
So I quite like Bitcoin for the job, but to be fair, that's not quite ready either.
Sure, but something that can't just be printed is the thing that we're looking for, right?
Well, yeah. Yeah, and that's why Bitcoin's got, because it's got a 21 million limit. But that is so far outside of the conversation at the moment.
Yeah.
I mean, half of the people listening to this are going to be shaking their head at the idea of it being Bitcoin, let alone the banking establishment. There's no way that they're going to go to that. Yeah. Now, the other thing I should touch on is the sort of specifics of what's actually happening here. Because, I mean, if you're tuning into Brokenomics, you probably want to understand exactly what has actually happened.
Yeah.
So I'm going to have to be a little bit technical, but I'll try and keep it as light as possible.
Where it's confusing, I will ask questions.
Yeah. Okay, so people may have heard of the yield curve being inverted.
Nope.
Right. Okay, so I'll only mention that the once, and then I'll keep it in plain language from this point forward. So the way it should work, like let's say you're going to lend me money. If it was for this afternoon, you're probably just going to do it. Here's a fiver. Get it back to me when you can. It's like that kind of thing. If it was for say 2 years, you're going to want an interest on that, and if it's for 10 years, you're probably going to want an even higher rate of interest on that. And actually, the longer you lend the money for, the higher you're going to want that interest rate to be, because there's other things that you could be doing with it. So it is normal for I'm going to mention it one more time, the yield curve to be that slightly lower rates at the short end, and then the higher rates as you go further out. Okay. What they did is, because they had such a long period of cheap money, all the long stuff is quite low rates. And then they, in sort of just the last couple of years, they've been pushing up the short end.
This is what we were talking about yesterday, right? So it's the 4.5% interest on 2-year ones, 0.5 on 10-year ones.
Yeah. I mean, so even the 10 years ones will be going up now, but they're trailing behind, and so you've got this sort of inversion.
So you've got a kind of bump in the curve, rather.
Money now is a bit cheaper than money in the future, and it shouldn't be that way round. Yeah. Now that's a really big problem for banks, because what banks do is they borrow money on a short-term basis. So you go and put money in the bank, and you can take it out tomorrow, the next day if you want, or you can take it out a year later. But typically that is. It is short-term money, but then they lend at the long term. So I will lend to your business a 10-year loan, or I will lend you for your mortgage a 30-year loan. So they got this problem that they've got a duration mismatch. Now, that's fine. That's what banks do. They manage duration mismatch by having borrowing short and then lending long. The problem is when the price of those two things gets out of kilter. So what's happened is the money that they would have to pay out on the short end exceeds what they're getting in on the long end.
Right.
So they're double screwed, because not only have they got the duration mismatch, but it wouldn't work.
They can't even balance it out in the long run.
Yeah. And this is why you would expect this going into, say, 2019, because over, say, from 2000 to 2019, anybody who sort of had a bank account for that long would have had the experience of, and you might remember this, every couple of months you get a letter from your bank over that 20-year period saying, oh, by the way, we're reducing the interest on your current account. And eventually it gets down to some ridiculous number. It's like 0.003% on your current account, or I think some of them, I think my Lloyds one even just stopped paying it at all. Right. They just got rid of it. But that's not the experience of the last 2 years. Over the last 2 years, actually short-term money has been getting, the price of it has been going higher. So banks have been earning higher amounts of money on these short-term deposits, but in order to make this work, this inverted yield curve, they haven't been passing that on to customers. And so, I mean, even though they're making a much bigger profit at the moment, but that is making this duration mismatch thing for them work.
Right.
Okay. And the customers, people like us, we've been sort of okay with this because we've kept our money in the banks. But what's starting to happen is people are realising, oh, hang on a minute, rather than keeping all of my money in the bank, I can go and buy a money market fund or some other sort of treasury deposit type thing, and I can get 5% on it. So why don't I do that? Now, it didn't really happen so much as when we were ticking up the interest rates. It didn't happen so much at the low levels, but now it's sort of hit 4 or 5%, and people are really waking up to this. So money is flowing out of the banking system.
Which is probably alarming for the banks.
Well, and that was the setup for Silicon Valley Bank, because money had been flowing out.
Yep.
And they also had the problem that I described yesterday of the underwater bonds.
Yep.
And then it sort of hit crisis point.
Right.
And so the reason I call Silicon Valley Bank a symptom rather than it's certainly not the cause. So some people are going to be telling you that Silicon Valley Bank has blown up the banking system. It hasn't. The banking system has blown up, and Silicon Valley Bank has been the pustule that explodes first.
Yeah.
So the problem the banks have got is they in order to stop the outflows, they would have to start increasing the deposit rate that you get by keeping it in a bank. Otherwise, people are going to keep going out to money market funds. But if they do that, they wipe out their profitability because they're having to lend at this low rate and borrow at this higher rate.
Yeah.
So they're kind of screwed. They're trapped in this situation.
Yeah.
And then the regulators are trying to figure out a way around this.
Right.
But there isn't one because they're going to have to fudge it. They're going to have to bail out. They're going to have to come up with another piece of duct tape to sort of keep this system going for a little bit longer. So it's not an ideal situation.
It doesn't look like there's a way out.
I mean, they have found a temporary solution.
Oh yeah.
Which is to say, okay, we're going to kind of bail out the bank. It's a bit different to the 2008 bailouts, because in the 2008, when they bail out meant the whole capital structure, which includes the equity tier. So the managers and the shareholders also got bailed out, and all the stock options were preserved and that kind of thing. And this time, because it's the slightly smaller banks, they're wiping out the equity tier. So the depositors, the people who put their money in the bank. And you can kind of see that. That's kind of fair enough, because if you're just opening a bank account, you shouldn't have to due diligence the bank for a bank account. You're just putting money in a bank. You're not expected to do that level of research, whereas an equity shareholder is expected to do that level of work. The managers are expected to do that level of work. So they're doing this sort of semi bailout. The problem is they just, there isn't enough money to do that for the entire banking system. So, and actually there was a comment on our video yesterday where we sort of briefly touched on this in a 20-minute segment. And one of the comments was, it's a bit like a boulder that's on a hill, and then everybody underneath it is holding up the boulder. And as long as everybody stands there under the boulder holding it up, then everyone's fine. But people are starting to think, oh, hang on a minute, if everybody else leaves, I'm screwed. So I'm going to step out of the way of this boulder. And there are fewer and fewer people holding this boulder up now. And it's getting heavier and heavier. And at some point, if enough people step to the side, it's just going to go bush. And the whole banking system is going to come down. Which would be bad.
Yes. Right. So, okay, so that's the situation we're in. I saw that Biden had given a speech. I saw the Bank of England put out a statement saying, no, everything's fine. Trust us, bro.
Because they need people to keep holding the boulder up.
Yeah, absolutely. Exactly, yeah. HSBC bought Silicon Valley Bank for $1. Why would they bother?
I think they bought the UK arm of it.
Right.
So, I mean, another aspect of this that people keep highlighting is there was a super woke risk officer or something. So I think the situation is that the US half, the senior part of this organisation, they didn't have a risk officer. Or they didn't have a head of risk. They would have had risk officers, but they didn't have a head of risk. And so the most senior one left was this woman in the UK, and she was basically spending her time doing alphabet people stuff instead of her job. So
there's no doubt that they were not only institutionally woke and therefore incompetent, but this isn't their fault. And they couldn't have stopped this even if they wanted to, right?
So, knowing what they know now, they could have stopped it.
Right.
But, I mean, that's always the case. If you know what you know now 2 years ago, you can always get around. So the problem with Silicon Valley is they actually believed the feds.
Right.
Okay. So I can make an argument that Silicon Valley Bank did nothing wrong.
Right, okay.
But it's not a situation I would have been, because I do not trust a single word that government says. I don't trust a single word that the Federal Reserve say. So if you remember a couple of years ago when the inflation thing really started to manifest, or maybe 18 months ago when it was now, the Fed was coming out and saying, it's transitory. Don't worry, it's transitory. It's going to go away. Right? Now, I didn't believe it for a second.
Obviously.
You're not a finance guy, but I bet you didn't believe it for a second either. But Silicon Valley Bank did believe it. They actually believe the Fed, Okay. But I mean, and the whole reason they bought all of these bonds in the first place is because that's what the feds were telling them to do. You are supposed, the regulators and the feds were saying you are supposed to go out and buy bonds. So they did.
Yeah.
Oh, okay, well we do that then.
We're good little conformists. We're going to do precisely what we're told.
Precisely, and then the Fed, when they're saying it's transitory, it's not. They weren't just saying that; they were also putting out monthly projections on what they thought in the future interest rates and inflation was going to be. And if you looked at those official forecasts, they did everything right according to those, because they thought, well, this is going to be a short-term thing; it's going to come back round. So by the time the Fed had actually said, well, actually, we've screwed up. That whole transitory thing, that isn't real. It's the rates are going to go to the moon.
The forecasts were BS.
Yeah. By the time that the official message had changed, it was too late to hedge the portfolio that they had.
Right.
So the Silicon Valley Bank argument that they didn't do anything wrong is that they didn't do anything wrong according to officialdom. They just... It was because they believed the government. But I mean, to be fair, the last 3 years is the story of people getting screwed over because they believed the government, or hiding in their basement, or wearing a nappy over their face when they went to Tesco's or whatever it is.
All I'm saying is nobody regrets not getting vaxxed.
Yes.
Moving on.
And nobody in the banking sector regrets hedging when they were told it was transitory. It's the same issue. Yeah, it's just a different way of getting poisoned. You're either financially poisoned or something else.
Yep. Right. So, where does the Biden regime come into all of this? I mean, apart from being the government that
they have
made the claims.
I've got to say, the extent to which the Biden regime has screwed up on everything is truly impressive. Truly impressive. I mean, if you got the world's best military experts, you couldn't have planned something much better than the withdrawal from Afghanistan. If you got the world's best financial expert and you were trying to wreck a country, you couldn't do much better than what they've done over the last 2 years.
What I find really interesting about it is that literally Biden seems to be committed to doing the opposite of what Trump has said. Trump says he'll do something, and then Biden is, for some reason, committed to the opposite, even if it's suicidal.
And sometimes he comes around in time, but only after the damage is done.
The damage is always done first.
But yeah, his mess, just astonishing. And Janet Yellen. So I've been listening to a lot of finance people's takes on this, and they are incandescent about the actions of Janet Yellen.
Really?
They were all screaming for her to be fired. I mean, the most visible manifestation, as we covered yesterday, is that Yellen was in Ukraine. Just
guaranteeing
4 or 5
them
days ago. Yeah, guaranteed
trillions.
And was it the Babylon Bee? They put out a great little skit, which was Biden reassures the American public that their deposits are safe in Ukraine, which is pretty much the problem.
So, what happened? Like, what can we expect in the next couple of weeks? Would you say?
Oh, that is very difficult to say.
How bad is the bleed going to get?
So it looks like it's been paused, for now, but this is what sort of ran through the story earlier.
Enough people are holding the boulder.
So they have convinced the people to stay behind the boulder for now. But
it's a great metaphor.
Yeah, increasingly people are going to be. Is this a really good idea? Because some people are suggestible. Like people like you and me are already well to the side, and we're saying to the people behind the boulder, "Come on, don't stand there." And they're like, "Conspiracy theorists, we're going to stand there." But at some point, this is going to manifest in another way. Whether that manifests, so for all I know, this taps it down for another 6 months or maybe 2 years or something. Or for all I know, something else blows up unexpectedly next week. I just don't know exactly how it's going to fall. All I
assume the boulder is getting heavier.
Oh yeah. Every month, the US and the whole Western world they are accumulating more and more debt. So that boulder is just growing bigger and bigger and bigger. And that's the other issue with the whole generational stuff. So the whole reason we've got into this stuff, into this situation with the boomers' entitlements and everything, is all of our assumptions about how a society should be structured are based on the idea is that next year there will always be more people. Because that was the boomer experience all through their generation. Is there was always more of them. Right. Yeah. So if you can run a Ponzi scheme of a pension, you can run a Ponzi scheme of a social security and all that kind of stuff, because you pay for what people are consuming then, and you just push the problem into the future. But that's fine because there's more people in the future.
And this is the crux of the Conservatives' need for immigration, isn't it?
Yeah,
So they just aren't more people.
They need more people in order to make the maths add up.
Yeah.
But what they desperately want to believe is that you can get people, just land them here from wherever, and they will be just as productive as the people that are already here. So the OBR forecasts say that, but the actual reality is that it doesn't work like that.
To watch the full video, please become a premium member at lotuseaters.com.